physics, a lever is a neutral tool, a force multiplier. Debt functions the exact same way. Used correctly, it allows you to lift heavy assets like real estate into your portfolio. Used recklessly, this mechanical advantage can drain your future income. The challenge is that the lending industry rarely explains these mechanics clearly. Instead, banks often rely on a dense fog of overlapping jargon, terms like revolving credit, or unsecured lines, or bridge loans, to categorize their products. To cut through that fog, you have to stop looking at loans as just money and start matching the specific structure of the loan, collateral, and repayment terms to your goal. Every lending scenario involves a foundational trade-off, risk versus cost. Generally, if you want a lower interest rate, you have to accept more personal risk. If you want more safety, you'll likely pay a higher cost for the capital. Navigating these options safely starts with identifying which side of that risk-cost equation a loan occupies before you sign the contract. We can map the entire lending market using two specific metrics: the cost of the capital and the risk assumed by you, the borrower. This chart maps the lending landscape. On the horizontal axis, we have the cost of capital, ranging from low to high. On the vertical axis, we plot risk to the borrower, from low to high. Look at the extreme ends. Mortgages offer cheap capital, but they sit high on the borrower risk axis because your home is the collateral. On the opposite side, payday loans carry massive costs, yet they technically pose less risk to your physical assets because they aren't backed by property the lender can immediately seize. You have to navigate this landscape based on your current financial health, rather than following generic advice that ignores your specific situation. Moving through this landscape without understanding these underlying mechanics makes it difficult to find a loan that actually serves your long-term plan. The most significant dividing line in debt is a concept called collateral. A secured loan requires you to pledge a physical asset against the money. Mortgages and auto loans are the most common examples, where the house or the vehicle acts as a security deposit for the bank. Because the lender has a tangible asset they can sell to recoup their money, their risk is lower. They pass that benefit to you through significantly lower interest rates. The trade-off is leverage. If you default, the lender holds the legal authority to seize that asset to settle the debt. Unsecured loans, like personal or student loans, flip that dynamic. There is no physical collateral attached. If you miss payments, your house or car remains safe from immediate direct seizure by the lender. Without an asset to fall back on, the lender takes on all the risk. To protect themselves, they require higher credit scores and charge substantially higher interest rates. Effectively, you must decide if accessing cheaper capital is worth the risk of losing your physical property if things go wrong. Beyond what backs the loan, you have to consider how the money flows during the repayment process. An installment loan, like an auto loan or a business term loan, provides a lump sum upfront. You pay it back in fixed, predictable monthly payments over a set period of time. That predictability comes with a lack of flexibility. If you need more capital halfway through the term, you usually have to start an entirely new application process. Revolving credit, such as credit cards or HELOCs, functions differently. As this diagram shows, you can borrow, repay, and then borrow those same funds again up to a specific limit. However, variable rates and no forced payoff date mean paying only the minimum risks a cycle of perpetual debt. Then there are payday loans. They offer immediate cash, but carry astronomically high rates that often lead to a rapid debt spiral. While predictable installment payments help build a steady financial rhythm, revolving lines require strict discipline to avoid becoming permanent traps. There are also specialized utility loans designed to fix structural problems or bridge timing gaps in your finances. A debt consolidation loan is a tool used to combine multiple high-interest debts into a single product. The outcome is a single, more manageable monthly payment that can help simplify your budget. The trade-off is time. By extending the repayment period to lower the monthly cost, you often end up paying more total interest over the life of the debt. A bridge loan fills a short-term liquidity gap. For instance, if you need to buy a new home before selling your current one. These are expensive and require precise timing. If the sale of the old asset is delayed, you could find yourself paying for two massive loans at once. Utility loans don't make debt disappear. They simply restructure the timeline and complexity of what you owe. So, with all these options on the table, how do you determine which one fits your current life stage? This framework is based on your objective: acquire an asset, manage cash flow, or fix mistakes. Starting out, avoid payday loans and prioritize safeguards. Federal student loans are a prime example, providing safeguards through fixed interest rates and legal protections. For those at the beginning of their financial journey, prioritizing these structural protections is often more valuable than having fast access to cash. If you are already managing multiple debts, your path focuses on optimizing your payments to lower your monthly overhead. But remember the trade-off we discussed earlier. Choosing a consolidation loan to gain breathing room today usually means committing more of your future time to debt. Finally, for those with established assets, the goal might be strategic leverage, using existing home equity to fund new growth. A HELOC offers flexible, low-cost capital, but it places your primary residence directly on the line. This is perhaps the clearest example of the risk versus cost trade-off we've seen. Ultimately, managing debt effectively is about ensuring the specific engine you choose, whether it's a mortgage or a personal line, is the one that actually aligns with your risk tolerance and your current goals.